IVM.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta B50 on Twitter, and this is a really special one. I am honored to have a market veteran, Devina Mehra of First Global, founder, chairperson, and managing director at First Global, and on our first time on this podcast. So stay tuned as we talk about the market outlook, First Global, small case, and much more right after this short break.
$100. That's all it takes to begin your journey with Bitcoin and Ethereum. No, really. With CoinSwitch, you can start investing in over 100 cryptocurrencies with just 100 rupees. On top of that, there are zero charges for deposits and withdrawals, so you can trade, buy, sell, however and whenever you want. All of this, plus their extremely intuitive interface, makes CoinSwitch the perfect app for beginners in the crypto space. But don't take my word for it. Just download CoinSwitch for free and try it out for yourself. If you'd like more information on cryptocurrencies, tune into a show about crypto with me, Rohan Joshi, my new adventure on IVM podcasts. CoinSwitch, kuch to badlega.
And welcome back, folks. Like I said, our guest, Devina Mehra, founder, chairperson, and managing director at First Global. Devina, welcome to Paisa Vaisa. Thank you so much. It's an honor to have you. Thank you so much for doing this for our listeners.
Thanks, Anupam, for having me.
Great. So, a very quick introduction to maybe the very few people out there who haven't heard of First Global. If you can just walk our listeners through what First Global.
Right. So, the First Global story started nearly 30 years ago. And for many of your viewers, that would be most of their lifetime, I guess. And it was that far back when securities and broking houses could not be companies. They had to be proprietorships and partnerships. So in the first phase, I started out, in fact, as a BSE stock exchange member, because that was the only stock exchange at that time. And then, of course, NSE came and we became a corporate member. And so the first phase in the 90s was primarily as two things: as an institutional brokering house catering to foreign institutional investors, what are called FPIs now. And the other was some amount of investment banking, because that was my background from my banking days. So that was the 90s. Towards the end of the 90s, we did something very, very unusual. So that was the next phase, which is that we went global. We became members of the London Stock Exchange and then the NASG. And this was so unusual that we were the first Asian members of the London Stock Exchange outside of Japan.
Wow.
So we have been following global markets also for over 20 years. And part of the trigger for that was the Asian crisis of the 90s, which showed us how risky it could be to be in a single market. So that was, you can say, a phase two. And then over time, from being what is called the sell side, which is the broking and investment side, we moved to the buy side, which is the asset management side. So that has been the last 5 years. And along with moving to asset management, in fact, the two things are very intertwined. We moved to a more artificial intelligence, machine learning kind of model from the human traditional model that we were following and most of the market is still following. So that has been, if I talk about the landmark events, that has been the evolution. So now we have asset management products both globally and in India.
Fantastic. So let's start from your recent blog post, right? You've got the blog at the First Global website is quite interesting, and there's a post there where the title is "How the Investment Field is Changing and Why You Can't Afford to Be Left Behind." What is this about, and what's your central thesis here?
Okay, so first, let me tell you, playing field changing is a metaphor, but you can actually literally see the playing field change. You've seen it change in several sports. For example, hockey, if you look at, there was a time from 1930s up to the 1970s when India and Pakistan dominated field hockey, because stick work, dribbling, all of what Major Dhyan Chand was famous for, all of that was the skill set that Indians and Pakistanis were good at. And then literally the field changed. It became AstroTurf. So it was a plain surface. And there something else became important, that how fast you could run, how fit you were. And you've seen that story in many, many things. In tennis, of course, you went from wooden rackets to metal rackets to titanium rackets and so on. Or even there was 100 years ago, horse-drawn carriages gave way to automobiles. And you could have made the best horse-drawn carriage in the world, and it would not have been able to take on the automobiles. And just as today, you have electric vehicles. So, as an automaker, if you say that I want to stick to the combustion engine and not move to electric vehicles, you will be left behind. So, the point I'm making is in investing, also, there is a very seminal change happening, which people are not recognizing by and large, or it is, people don't want to get out of their comfort zone, whatever it is. So, because earlier the edge in investing came from getting information. So I have done a lot of that. I have gone through, all the dusty industrial estates in India, from Hyderabad to Chennai to NCR and so on, and visited plants in even more remote places, from Renuput to Wadi. But that was then. I mean, most fund managers are still stuck in the 90s or earlier and doing things the old way. But now the edge is no longer information, and all around the world, that edge has been regulated away largely, that you cannot give differential information to anyone. Even a con call transcript has to be put out in the public domain. So now something else, like the AstroTurf, now everybody has the same information. Now something else has become important, that how do you analyze that information? How do you get insights out of that information? And there's a mass of information. So we found that the only way to really do it is to use the machine, to use artificial intelligence and machine learning. And it's been a process. It's been a long process, a very rigorous process. But it's not an easy thing to do. But we realized that was the only thing to do, because globally, for example, we look at 20,000 securities to get whatever, maybe 100, 120 securities that we like. That process is impossible to do manually, both in terms of the amount of labor required, in terms of getting consistency. And as life has gone on, you realize how many biases come into play in human decision making. So all of that goes away. And to an extent, I will also say that this sort of the key was the reason we got into asset management, especially in India. I mean, our first time we got our PMS license was in year 2000. We waited almost 2 decades before launching our product, because we said that unless we have something that is consistent, that is predictable, there is no point launching a product for the sake of it, because taking someone's money is a huge responsibility. With your money, you can play around more. You are okay if, some things go bust, and, two of your winners make up for a lot of other sins. But that's not the way you can take other people or public money and manage. So this has been the key, and this has been a change, and which is why you find that human only managers very rarely now consistently outperform the market, because the field has changed and you have to change, otherwise you will be obsolete. Just as in the world of electric vehicles, the old cars would become obsolete in a few years.
Very interesting. From information being an edge to now analysis. So, Devina, you're a veteran of this market, so you'll remember the late 90s, 1999, 2000, when the tech boom had happened. Even in India, you would have the Wipros and the Infosys trading at 150 times price to earning multiple, then people just
Right.
still writing a lot of reports, saying that it's still a buy. And today, 20 years, 21 years later, you've got quote unquote new age companies. Let's talk about that. That they've got a lot of attention, ways to value them. I have no idea. Tell our listeners your thoughts on these companies, probably ways of valuing them, anything at all.
Right. I mean, I always say that when you are looking for a new way to value something, you are not really looking to value it. You are really looking for a way to justify what you are paying for it. So because there is only one way to value companies, which is to look at what cash flows they will generate over a period of time. And so I mean, just like to give you a few data points. One, of course, I often say that having been around too long, I don't know if there's an advantage or a disadvantage, because you remember too many points in history, and this IPO frenzy comes and goes, not just in India but elsewhere. Recently I was reading about the IPO frenzy on the Paris bourse in 1881.
Wow.
Wow. Yeah, when those people selling pancakes would wrap it up in shortened prospectuses. In India, you have seen it come and go many, many times. So many people would remember that Reliance Power was a very coveted IPO, and then it went bust. But even DLF, for instance, it was a coveted IPO, very much oversubscribed. It listed and doubled also. But then it never saw those prices ever again. And so also you can come up with many examples like that. On the other hand, you mentioned Infosys. I don't know whether you remember that Infosys IPO was undersubscribed in
Yes,
the
of course.
90s,
Yeah, yeah.
and yet that became a winner. So first thing I would like to tell people is that just because something is there's a lot of interest or even over subscription doesn't mean it's a lottery ticket that if you get it you will win. So to some extent it is good that the Paytm example at least sobered up people a bit who thought it was like a free ride or something where you are bound to make money. So that is one. If
Sure.
you look at the international experience, if you look at Uber, Lyft, DoorDash, etc., post listing experience has not been great. In fact, just last night I was looking at a statistic. There's an index compiled of companies which are not making profits in the US, and that index has not moved for a year.
Wow.
That Nasdaq has been such a good performer for the past year, that index has not moved. So people don't look at data. We always say that for anything, if you are making a case for or against anything, first look at the data. And I think too much of people's mental space is getting taken up by this, that you have this FOMO that if I don't participate in this IPO process, I'll get left behind. So this is only a small part of what your portfolio should be. So don't divert too much of either your money or attention to this. The other thing is that the companies themselves, we call them tech companies, but their edge is not technology. The edge is, it's not as if that they're doing something high tech which cannot be copied. It is mostly a platform business or a direct to consumer selling business. So those kind of businesses, real thing is only the brand, which in some ways is how much money can you spend on it. So there, being in the public markets may well be a negative. That is something people don't realize. But if you look at the prospectuses of virtually any of these companies, whether it is Policy Bazaar or Paytm or Zomato, the last 1 or 2 years of before going public, they cut down on their promotional and marketing expenses to make the financials look better. Now, most of the time, it still doesn't get them to profits, but at least the losses look better. Whereas you might still be competing with companies which have the VC money funding it, which is not so sensitive to what this quarter's financials look like. So it becomes an unequal fight, which is why in many of these cases, you will see that there have been market share losses even before they went public. And then when you go public, there is that quarterly pressure from the analysts. So you need to perform and you need to show the results. So that becomes an issue. So you're actually at a disadvantage vis-a-vis the private players. So those are the things that you have to keep in mind. So I would say be very careful. This is not a segment where a lot of your money or attention should be going.
Sure. You mentioned the example of IPOs in Paris and the whole, the pancake thing that you mentioned. So I have to ask you,
Yeah.
and I thought I'll sneak in this as a kind of a surprise question. But what's your reading list like? I know, from your interviews and from your Twitter feeds, you're a very well-read person. What are you reading right now? Any books that you, or for that matter, any content? Because these days, of course, it's not
Yeah.
just books from where we get our
Right.
information and our insights, but anything at all that you want to share with our listeners.
Yeah, actually, I have done a lot of reading in the past also. So, I always say that if you want to do this seriously, that 10,000 hours of work is essential. So, in my home, there are literally thousands of books. 10 years ago, I counted, there were over 2,000. Since then, of course, it's mostly been on Kindle. So, it's now even easier to anything that you read about or you see. So there are like whole lot of things that you have to read from if you're really starting out, from absolutely basic fundamental research to reading about great investors, great traders, great business people. So all that gives you insights, because ultimately investing is also investing in businesses. So you have to understand that. There's also a category of books which I've spoken about often, which is to really understand your mind, your biases, your thinking. That is so very important. So some of the books, of course, I've spoken about in the past, like Thinking Fast and Slow. There is Richard Thaler's books. There are Nudge, which is from him, and also some others. There is The Halo Effect. There's the invisible gorilla. So many like that. So it's very important to understand what your biases are, which is, of course, not to say that if you learn about the biases, you'll be able to eliminate that. Daniel Kahneman says that I spent my lifetime researching biases, but I don't think my decision-making process has changed that much. So that is the other thing. But I mean, you must educate yourself. There is no, I mean, right now, I read all kinds of stuff. In fact, I also tweeted that I recently even reread Harry Potter books. So I read all kinds of stuff.
Was that fun?
I was reading Numbers Don't Lie. That's interesting. That is like all kinds of statistics from everything about how long empires last to like, for example, this is another thing which is of relevance. People think that some great innovation comes about and it will change the world, and therefore I should invest in that, and that will make me money. That's also not an easy formula. I mean, I was looking at solar energy, for example. Photovoltaic cells came out nearly 150 years ago. It came in usable forms in 1960. And it is only estimated that by 2030, you will have maybe 15-20% of the energy from solar energy, so of the electricity production. So it has taken, 150 and then 70 years to get to that. That is the sort of thing people forget. And even things which actually come about and change things like automobiles or aviation, there are always a number of players that come in, that many don't survive, and even the survivors don't necessarily create shareholder value. So feed your mind with data. I mean, don't spend a lot of time just listening to your friends or even people on TV or whatever talking about stocks. You do basic work first. Otherwise, you can waste a lot of time. I mean, that is
Very
the thing.
interesting. How was reading the Harry Potter series all over again? Was that fun?
Yes, it was. I mean, it also showed you the power of a good story or a good plot, that it keeps you engaged and it keeps you going, and you actually read it quite fast. That is the thing.
So many quotes from that book that are that are as relevant to life in general.
Right.
What Dumbledore says to Potter. Anyway, sorry.
Right.
I'm also kind of a Potterhead, but let me not go in that direction. So before we go into a break, your thoughts on this international and global investing crypto. I mean, see, HNIs have had a whole range of options now in the last couple of years that they probably didn't have 10 years ago, 20 years ago. And you would know that. HNI money would probably go to real estate or to some extent stocks. Today, the landscape has totally changed. So two specific areas: international investing and crypto. Your thoughts?
Okay, so global investing, I mean, we can take some of the credit for having sort of focused people attention on this, because 2 years ago, we had released some statistics which showed that in dollar terms, being in India had been a very poor investment. You barely had compounded anything at all, even over as long a period as 10 years. So you would have been better off going global. So that of course, suddenly now, it's become a buzzword. That's what actually happens, whether we talk about asset allocation, quant investing, global investing. So all these things, when we have talked about, it's with a lot of work and rigor, but it becomes just a buzzword that people throw around. So global, first thing which you have to remember is that global investing is not the same as just investing in the US. People think being global means that you open an account and you start trading US stocks, or you buy an NASDAQ or S&P ETF or something, and that is it. But that is not the case, because what people don't realize is there is this recency bias that you can't go wrong buying the US. But what you are doing now is that instead of being only in one country, India, and one asset class equity, you've added one more country, same asset class. But that is not good enough diversification. So if you're looking at real asset allocation, and the leadership changes. If you look at India, for instance, last 4 or 5 years, if you look at the list of best performing markets in the world, India has been 19, 20, 21. Only this year it is among the top. So NASDAQ, because it has done well in the last 2-3 years, people think that it has always done well. Again, you look at the data, that 2000 high prior to the crash, NASDAQ did not take out till 2015.
Wow.
As 15 years. I mean, S&P went up by 2007 and then again had a crash. So that is why you have had this great run, because you had that on a 20-year rolling return basis, you were much, much below trend. So also in India, again, that's been the similar story. So nothing lasts forever. There was a whole period between 2003 to 2007 where US underperformed hugely, in spite of being, even after the crash, it did not make it up. And at that time, you can always find a story to justify anything. So that time, the story was that the US story is over and the action has to move to emerging markets, and they are the countries of the future. So you had this 5-year run where emerging market index went up 3.5 times, India went up 5-6 times, Brazil went up 10 times, and so on. And then the game changed. So previous decade, it has again been the era of more US and less emerging markets. So that always keeps changing. The asset classes that do well, like during the tech crash, if you see, oil did well, US treasuries did well. So there is always action somewhere. So you have to look at the whole global pie chart in terms of asset allocation, in terms of geographies. And that's not easy to access, both in terms of the access itself and to get someone who understands it. So we wanted to do something for the Indian investor there. So which is why our global product, which actually is this multi-asset, geographically diversified product, starts at $10,000 only. So that's 7.5 lakh rupees. So that's, normally, even if you are an international investor, you can't get access to something like this for below, let's say, $1 million or so. So, this was something we wanted to do, that the Indian investor does have a real chance of diversification. And it is important because the Asian crisis, I mentioned earlier, the markets like Thailand, Indonesia, Taiwan, etc., which were the Asian tigers and which were like the places to be in the 90s, suddenly were down 50 to 90%. So if you were in those markets alone, that's how your net worth or investment value would have been wiped out. So it's very important to avoid what we call SCARs, single country, single currency, single asset risk. So, look at your portfolio as a whole. Where is it? What assets? What sectors? Always step back and have a look. And sometimes, what you find might surprise you. And I find this even with larger investors. I've seen family offices have one impression of where their assets are. And when you actually do the numbers, it's something quite different. So very important.
Sure, crypto.
Your thoughts about crypto, which is a completely different thing altogether. So crypto, see, I'm not one of those who says that this is a useless asset class or it will never be an asset class. It is on its way to becoming an asset class, but it is a very volatile asset class. So again, it is not the time or place to have an outsized portion of your portfolio in it. What scares me is that I find everyone from people who have retired and to people who have just finished college and haven't got a job, all saying that now I am into crypto trading. Wow. So that is scary. So I mean, at various points, not directly cryptocurrency, but we have through other securities have an exposure to crypto, but that has been like more than like 1 to 3%, that kind of proportion of the portfolio. So we're not going to put 20% into crypto assets. What is more interesting and worth tracking is blockchain technology, because I think that will have an impact on a number of industries. So that is something that you can look at. But again, I find that a number of products come in which are only adding layers of intermediation. So if you want to buy a blockchain ETF, you now can go and buy a blockchain ETF. You don't need an intermediary and so on, and also anytime any product comes which is either geographically or sectorally themed, it normally comes towards the peak of that theme, because that is when all the general public also knows about it and wants to get onto the bandwagon. But that, whether in the past you look at technology funds or pharma funds, and now it is maybe blockchain, maybe it is a China fund, those always come towards the end of the cycle. So be again cognizant of that. And because as a lay investor, it is very difficult for you to make those calls that now is the time to be here or now is the time to be there. For that, you need knowledge of a professional who can do that tactical allocation.
Got it. So folks, on that note, we'll take a small break and we'll be right back with much more on the other side of this break.
We know you love fast food,
fast fashion,
faster payment,
lightning fast internet speed.
Then why not fast information?
on Think Fast, where we discuss the latest developments in the world of technology, business, marketing, pop culture.
With a side of sarcasm and my dad jokes, not just mine.
Not mine, Varun. My jokes are funny. So join me, guys, the funnier one, Suchita Salvan, co-founder of LBB.
And me, Varun Dugirala, the co-founder of The Glitch, as we think fast only on the IVM network.
Fresh episodes out every Monday.
On the IVM app, website, or wherever you get your podcast from.
Okay, so Devina, now let's talk about the first global human and machine model. This is the small case that you are offering now to pretty much everybody who can buy the small case on the small case platform. Tell us what
Right.
exactly is this small case about?
Okay, so the model that we use actually is, in some senses, the basic model is the same across the all our products, which is this human plus machine model. So what we have is that I spoke about why the machine makes sense in terms of volume. It can analyze in terms of being consistent and bias free, which human beings can never be. But on the other hand, we do not like black box models where you don't know what is happening. And also when you which is why often when the pure techies come up with a model, it does not work because you are just analyzing thousands of factors and something will work, but that correlation may be spurious. I mean, I can plot cheese consumption and nuclear energy and the correlation might look one, but that is actually no causality. So what we do is we start the other way around. So you're looking at what are the factors that make sense logically to us, and then we come up with a model. And then even and we are trying to codify a lot of our expertise. So sometimes as a human fund manager, you feel a little cheated that I thought only I could do this or only human beings could do this. And over time you find the machine is also gotten trained to do it, like for example finding manipulation. So which was something we found in Enron or WorldCom and so on. And we find now the machine finds all cases of manipulation. There's not been a case in the last few years that was not flagged earlier. So, but we still need also a human being at the end of the process in many ways, because like whether it is a geopolitical tension or whether it is this COVID crash, which we sidestepped because of what we saw around, which was not necessarily yet in the data. But again, over time, a lot of things are moving to the machine. Now we are getting to a stage where we can analyze con calls, transcripts, and management reports and things like that. So that is our human plus machine model. And this is the model that, for example, in India, we have been using for our PMS. And since inception, our PMS has been by far and away the best performing multi-cap PMS. And not just in terms of returns. I mean, this I want to emphasize. It is also in terms of risk-adjusted returns.
Sure.
That if you look at returns relative to volatility or returns relative to drawdowns, no one is at even half our levels. And that has not come out of fluke. That has come out of this process where we are trying to manage. We always say that more than half of management fees we are charging are for risk management and the rest is for return management. So that same engine we are using. Again, there was a lot of demand because the PMS, the SEBI minimum is 50 lakhs. So there was a lot of demand that, why don't you offer something that smaller investors can use? And we actually had a smart basket product, but it was difficult operationally for us internally. So the small case platform was a good platform for that. So we're using the same engine that we're using for the PMS, but number of stocks is lower. Lower means it is still 25, 30 stocks. And small case, people think it means small cap. It is not small cap. It is a basket, which is multi-cap, which is diversified across sectors. And it's a one-stop shop for you that your entire equity investment, you can say that, yes, I can put it here. And then if we do a quarterly rebalance, but there might be changes during the quarter also. But, we are doing the monitoring. So it simplifies investment for people who obviously do not have the time or inclination to go into details everywhere. And if you want to see that firstglobal.smallcase.com. So that's go and see.
There you go, folks. You can check out the small case on, like Devina said, firstglobal.smallcase.com. From what I can see right now, the minimum investment amount is just about 1,60,000. And the access, from what I can read, is about 7,000 for 3 months. So check out the website for further details, plans, benefits, stocks, weights. Devina, I read in the product description, I find this really interesting. Okay, quote unquote, that strategy, that your strategy for the small case is one of taking a large number of small bets as opposed to the conventional strategy of taking a small number of large bets. And you believe that this can, and again I quote, that generate tons of alpha without adding proportionately to risk. Fascinating. How does this work?
Okay, so first of all, for the listener, let me just say alpha means that you are getting returns more than the market. So that's what you're talking about. So, I mean, I can prove it to you mathematically. This is not the forum for it. But if you are looking at, investing is a game of skill and luck. They're both the components. In fact, almost everything in life is that, barring chess, which is mostly skill. Everything else is skill come luck. So now, if you do have the skill, you want to, this, as I said, can be shown mathematically. You are better off if you spread out that skill over a large number of bets. So if you are right, let us say 70% of the time, no one is right 100% of the time. Then it is better if you take that over a large number of bets, because then the expected value will be close to what it should be. It's like tossing a coin. A proper coin should have heads and tails 50% of the time. But if you toss it 10 times, it can have 8 heads or 7 heads or even 9 heads. But if you toss it 100 times, then it is likely to be between 45 to 50, 55 heads. So then the variability will reduce. So if you have the skill, then you don't want to be just dependent on luck. Then you want to spread it over a large enough number of bets and you will come out ahead. So that is what, and as I said, that our first principle is to reduce risk, that you should not, as an investor, have a crippling blow to your investment. So which is why we sidestepped the COVID crash when a lot of funds and portfolios were down 30, 35, 40%, because once you're down 35%, it takes a 50% increase to come back to zero, to come back to 100. So that's very much a part of our process. We're talking about, other than books, I mean, there is an article called The Loser's Game by Charles Ellis. It is one of the most mind-opening articles I have read. It's, I think, 1975 or something, but it just like how investing is a loser's game, which means, first of all, you have to ensure that you don't lose, that you don't have such a big drawdown that you're out of the game. And by not losing, you will end up winning. So that, and we've seen this, that, I mean, we do not believe in very concentrated strategy in a particular period can also give extra returns, but that comes at a very, very high risk. And that is why sometimes we have people coming and saying that I've invested in this fund or that portfolio, it didn't perform for 3 years, now it's been performing last 6 months. So you will see that kind of volatility when it is as per someone's whims and fancies, I would say. I mean, even people who say that I invest in my circle of competence, I say it's a euphemism for comfort zone. As an investor, why should I be constrained that this fund manager does not understand anything beyond an X type of company or an X and Y sector? So, and for real diversification, you have to have it sectorally also, because even if you have 20 stocks and 7 are banks and NBFCs, 5 are pharma and 5 are FMCG, those packs will move together. So you do not have diversification at the level of that headline number of 20 either.
I think I should do a separate episode with you just on your reading list, because The Loser's Game by Charles Ellis is from 1975. It's not even a book. What you mentioned is from the Financial Analyst Journal, right? I mean, and that's one of, the Financial Analyst Journal, FAJ, is among the best places, and of course, among the lesser known places where you can get these absolute, these brilliant fund managers and investment professionals with some great strategies. What a reference out there. So folks, just Google this out, just The Loser's Game,
Yeah.
Charles Ellis, and please.
And it is about so many things in life. It is not just about investing. Like one of the examples he gives is that for a pilot, for example, that when you started aviation, you needed a pilot to be very adventurous, very aggressive. Like if you read this JRD Tata's flight from Karachi westward, in between he had to improvise on the parts and to continue with that flight. That was then. Then it was a winner's game. You needed to be unusual to be able to do that. But now aviation is a loser's game where the only way to do it is to go strictly by the checklist and make sure there are no mistakes. So the game's changed. And so also investing changed when even in India, let's say 30, 40 years ago, when there was far less competition, you could find something which no one had found. You can, companies were hidden gems. But now there is a lot more competition. So you have to first make sure you don't lose. You can't use the same strategies.
Yeah, I mean, what amazes me is that these obscure sources from back, like for example, let's take Thinking Fast and Slow. Everybody associates Daniel Kahneman with that because obviously that is the most well-known book, and people think that probably the process started there. It didn't. The original paper is from 1974. It's titled, I think it was titled Judging Under Uncertainty, Heuristics and Biases. Right? That's 1974. Anyway, moving on.
In fact, his next book, I'm still only a bit of the way through, which is Noise.
Noise, yeah. Oh, yeah.
Which is another interesting thing because it is not just biases. It is the fact that, so many things are random or just that judgments differ from person to person, which is why, one of the things which he says is that it is very rare to find a field where a well-constructed algo will not outperform a human expert. You look at X-rays and radiology studies. This is also a bit unsettling that when you show that same X-ray to different doctors, they come up with different results. That is one. But even the same doctor, if you show that X-ray 6 months later, they might give you a different interpretation, which part is scary. So that is why, they said as many things as you can put in that algo, you are likely to come out ahead with lower level of noise and lower level of biases.
And this is a book that he's written in, I think there are 3 authors to the book. So it's always, it's a much wider canvas, I think, as compared to that. So folks, there you go. That's another tip on your reading list for you. Okay. Last couple of questions now, Devina.
Right.
The cost for this, for the small case is about 7,000 for 3 months or something. I'm sure that our listeners can figure out what are the other costs involved there. But can you tell us what kind of investor is the small case ideal for?
Okay, so of course, the quarterly cost is higher as compared to the annual cost. I think is somewhere around 16,000, if I'm not mistaken.
Sure.
So that minimum that we had, that is calculated on the side, that 1.6 lakhs is just a calculated minimum, depending on what are the stocks that we have in the list, what are the prices, and what is the minimum lot size for that. So it's just a calculated number. So this is, as I said, ideal for anyone who is either starting out in investing or just wants a one-stop solution to their entire equity portfolio in India. So that is what it is ideal for. Probably at 1.6 lakhs, the fees might look high. So that's probably not the ideal amount, or at least you can start with that, but you need to build up to, I would think, at least 5-6 lakhs or higher. That would be a reasonable number to aim for. As I said, this is we think for the equity needs of a normal investor, who's not looking for crazy high risk or anything like that. This is we are looking at it as a one-stop shop, and we are not looking to have a large proliferation of schemes, that this kind of theme, that kind of theme, because again, then we are putting the onus back on the investor to decide when to move from one to the other, and we don't think that is the right way to go. So we will more or less continue with a single small case, and for that matter, single PMS also on our equity PMS. We have a multi-asset PMS also, which for people who are looking at lower risk, but again, we are not looking at a proliferation of schemes.
Sure. Folks, the key offer document and all the relevant literature and material that where you might have further questions are all available.
Yeah, we have in fact, very detailed FAQ on the small case site. Probably too detailed sometimes, I think. But
always good to it's always good to have more transparency rather than less. Okay. Last question, Devina, and the most obvious one, I think that probably you get asked everywhere, but your views on the outlook for Indian equities, given that, despite this market correction that's happened so far, everybody is bullish about India's economic growth. People are saying that this is 2003 all over again, all of that. So economy, markets, everything, your view.
I think a certain segment of the people are perma bulls on India. So anytime you ask,
hard to find a bear. Very tough to find a bear.
That India is a great growth story. In spite of the fact last few years have not been great, even prior to COVID. So somewhere, at some point that growth will come. But having said that, as far as the market is concerned, the thing was that from 2010 to 2020, you had a very bad phase. If you look at the Sensex return over 40 years, roughly, Sensex has been around a little over 40 years. So the first decade, that 1980 to 1990, you saw compounding at 21%. Next decade, it was 14, then 17. But this decade was only about 8.5. So and remember, this is at a time when fixed deposit rates were over 8%. So you didn't even beat fixed deposit rates. If you look at most equity mutual fund for the 5 years prior to 2020, most didn't even beat savings deposit rates. It was that bad. So you had that boom created. So you were that far away from the trend line. So now what has happened is that, yes, from the COVID lows, you have seen this big jump. But if you look at even on a 12-year period, your CAGR is only about 10.5. So you're not even still at the trend line. So that is what gives comfort that at least there is no great bear market ahead, because you've not had that big bull market. So regardless of that, there will be corrections, and which is what you live through. And always it happens that in theory, everybody looks for a correction, but when it actually happens, people start to panic. So, but you have to be careful in terms of sectors, because I don't think it is as if the economy is not hurting anymore, or the number of people who have lost their businesses or lost their jobs. So it's tough for a lot of people. If you look at the dichotomy even between the four-wheelers and two-wheelers in auto, you will see that two-wheelers are still struggling. So, and again, real estate, while of course for the listed real estate companies, mostly it is the high end that matters, where you are seeing the demand, but the rest of the market is not so great. So that you have to choose the sectors, you have to choose the stocks. But yes, I mean, overall, the market itself doesn't look bad at all.
Anything on the economy, if you track that, or are you more of a bottom-up person looking more at sector
No,
ideas?
as I said, in the economy, you're seeing this kind of dichotomy, that you have still a large portion hurting. Barring, I mean, agri part has been good. So we've had 2-3 good monsoons. So the agri part, that again has provided some cushion. But otherwise, at the middle and lower middle class level, there has been a lot of hurting even prior to the COVID. If you remember, even prior to COVID, our unemployment rate was at 40-year high. And then, COVID came along and created all those other issues. So we are not completely out of it. So let's not forget, that a lot of our fellow citizens are still struggling. So that part still remains. But as I said, there are enough places in the market where you can see that enough returns will be made. Some which we have liked for a while, some have new entrants, but there are enough sectors and stocks to make money on.
I just don't, I wish I heard that more often, that there are parts of our country which are still struggling. All the bullishness that's there around. Thank you for that very sober note. Last question, even I just want to ask you this, because you mentioned asset allocation a lot in the earlier part of this episode.
Right.
For someone who's new to the market, probably setting up a 10-year, 20-year, 30-year plan, what, directionally, what kind of an asset allocation would you recommend to him? Let's say if he's not savvy enough to go international, he's looking only at India. What do you think would be a right portfolio asset allocation direction that this person should take?
It is, difficult to give a one sort of solution fits all kind of number, because it also depends on what you think your cash needs can be in the future, in a 2-year horizon or a 4-year horizon. So it depends on a lot of things like that. But I mean, I would think that you should look at global also. I mean, you are saying don't, but I would say that do look at that, because in India, there are only a limited number of things that you can do other than equities. There is gold and there is fixed income. There's not a whole lot other things that you can do. So look at according to what how much risk you want to take. And if you are at a very early stage of your life, obviously you can invest a little more in equities. That's a traditional way to look at it. But also taking care of that, if you have a child, if you want to buy a house, all those kind of things also. So it's difficult to kind of give you a one formula.
Okay. Last question, passive versus active. You're someone who's First Global is someone that's like you said, established itself very clearly in the active space. There's this whole debate on passive versus active, and passive being this, that, and a lot of believers in that. What are your views?
Yeah. So first thing which I would like to say is that people think that being passive investing is low risk. So that is the first myth you should forget about, because passive means that you're going up and down with the market. So if you were a passive investor last year, you would have gone 30 to 40% depending on which market you were in. So that does not provide you any risk control. So you're just going up and down with the market. So if you can have a fund manager who can manage your risk, as I said, first focus, which you must always ask your financial advisor or fund manager, is about risk. That how do you manage risk? And we have like a long list of factors we look at managing risk. It's not just diversification, it is position sizing, it is looking at correlations between different stocks or different asset classes. There's like a whole bunch of things that we do. And that is one thing where we are very rigid. I mean, there we have no human intervention. So if you manage risk well, that is the first value add that an active fund manager can bring to the table if they know what they're doing. So that's the first thing you must remember, that yes, in passive investing, your costs are lower, but there is really, I mean, you're not managing risk. And plus, of course, then there is the value added of whether you manage to get to the right sectors and all of that.
Folks, on that note, that is a wrap on this episode of Paisa Vaisa. Like I said, it's an honor to have a market veteran on our shows. So that's a wrap on this episode. Devina Mehra, founder, chairperson, and managing director of First Global. Devina, thank you. Really, thank you so much for doing this for our listeners.
Thanks, Anupam. I really enjoyed this one.
Me too. Thank you so much, Devina. And listeners, if you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcasts on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. And thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Hey everybody, it's been another great week on the IVM Podcast Network. On Storytellers and Storysellers, Vineet talks to founders Dinesh and Vivek about the path-breaking changes their AR edugaming startup PlayShifu has brought about. On Think Fast, Varun and Suchita talk to communications consultant Karthik Srinivasan. He shares his insights on brand stories, woke culture, and regional content. On Cyrus Says, a cock and bull episode with ex-producers Naveen Narona and Abbas Momin. Cyrus asks if they ever participated in a fancy dress competition. On All Things Policy, the Takshashila Institute folks discuss the importance of digital equity in achieving true progress. And on Probation Se Promotion Tak, Abhinav gives us tips to be mindful of before seeking a mentor. Also, just one quick announcement for everybody. We would like you to check out the new version of our Android app. It's available on the Play Store. It's a really interesting take on how to listen to podcasts. Do give it a look and let us know what you think. We're open to feedback on all of our social media channels. We're IVM Podcasts on Twitter, Facebook, Instagram, and LinkedIn. Also, do remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. Word of mouth really does help. And don't forget to rate us on any of the platforms you're listening to us on. And you can also check us out on YouTube. And we have a number of channels there at ivmpodcast.com/YouTube where you can take a look at them. And finally, we'd like to thank our sponsors this week, Bank of Baroda and CoinSwitch Kuber. Thank you so much for making this possible.
Love fighting? We've got you covered. Check out our show, The Fighting Goat, where we, the voices of the internet, Arjun Chipalkatti and Somesh Kamra, bring to you crazy weekly action on your favorite combat show, The Fighting Goat.
Be it commentary, breakdown, predictions, analysis of styles and techniques.
And of course, your round of favorite fighters.
You can listen to us every Thursday on the IVM Podcast app, website, and all major podcast streaming platforms.